Let us look at another example of cost volume profit analysis. The Maxis Restaurants Incorporated has two restaurants that are open 24 hours a day. The total fixed costs for the two restaurants total to $450,000 per year. The average sales check per customer is $8. The average cost of food and other variable cost for each customer is $3.2. The income tax rate is 30%. The target net income is $105,000. Now we are being asked to find out the revenue needed to obtain the target net income. So let's say these are the two restaurants owned by Maxis Restaurants Incorporated. This is the first and this is the second. The total fixed cost for the two restaurants is $450,000 per year. So this is the landowner. So for both of these together, a fixed cost of $450,000 is being paid to the landowner. And this is the fixed cost. The average sales check per customer is $8. So let's say this is the customer. So on an average, the sales check is $8. That means each customer which is coming to these two restaurants is paying $8 to Maxis Restaurants. So the selling price is equal to $8 per customer. The average cost of food and other variable cost for each customer is $3.2. So the food which Maxis Restaurant is selling is made out of the raw food material that it is purchasing from the suppliers. So overall, the variable cost for each customer is $3.2. So let's say this person here represents the supplier for all the variable things, which is the raw material and labor. So Maxis is paying an amount of $3.2 per customer, and this is the variable cost. So here we have the source of revenue as the incoming funds from the customer, and the outgoing funds are the cost, which is the fixed cost and the variable cost, and the difference between the two will be our income, and on that income we have to pay income tax. Now the rate of income tax is 30%. So Maxis is now paying an income tax of 30% to the income tax department. Now with all this, after paying the income tax, Maxis wants to have a target net income of $105,000 per year. So now we have to find out how much should be the revenue. That means how much should be the total incoming funds to obtain the target net income. So here the information provided to us is the fixed cost, which is $450,000 per year. The selling price per unit is $8. The variable cost per unit is $3.2. The income tax rate is 30%. and what we want to achieve is a target net income of $105,000 per year. So basically here we have to find out the revenue required to achieve a target net income of $105,000. Now revenue is nothing but the number of units sold multiplied by the unit selling price. Now we already know the unit selling price, which is this, but we don't know the number of units sold. So this is what we have to find out. Now we can find this out using the formula of operating income. So the target operating income, which is equal to total revenue minus total cost. But here we don't have the targeted operating income. We have the targeted net income. So let's first find out the targeted operating income. Now we know that the target net income is nothing but the tax applied on the targeted operating income. So target net income is equal to target operating income minus target operating income multiplied by tax rate. So basically we are applying the tax on the targeted operating income to obtain the target net income. So target net income is given to us as 105,000 is equal to, let's say this is X, minus tax rate is 30%. So 30% means 30 divided by 100 into X. X is the target operating income, or 105,000 is equal to X minus 30 divided by 100 is 0.3 times X, or 105,000 is equal to 0.7x, or X is equal to 105,000 divided by 0.7, which is equal to $150,000. So basically the target operating income is $150,000, and if you apply a 30% tax on it, the target net income comes out to be $105,000. So now we can use this formula of targeted operating income to find out the number of units sold, and then we can use that to find out the revenue. So the targeted operating income is equal to total revenue minus total cost. Now this is equal to the number of units sold multiplied by the unit selling price minus the fixed cost plus the variable cost, which is number of units sold multiplied by the unit variable cost. So let's now substitute all the values that we know. So total operating income as obtained in the previous step was $150,000. This is equal to Q, which is the variable, multiplied by the unit selling price, which is 8, minus the fixed cost, which is $450,000, plus Q, which is the variable, multiplied by C, which is 3.2, or 150,000 is equal to 8Q minus 450,000 plus 3.2Q. We have not yet opened the bracket, or 150,000 is equal to 8Q minus 450,000 minus, now we are opening the bracket, so plus minus is minus 3.2Q, or now let's bring all the expressions with Q on one side and all the remaining on the other side. So this becomes 8Q minus 3.2Q is equal to 150,000 plus 450,000, or 4.8Q is equal to 600,000, or Q is equal to 600,000 divided by 4.8, which is equal to, so we can remove this decimal here, and because this is after one digit, we can add a 0 here. Now 6 ones are 6, so we'll add all the remaining zeros, and 6 eights are 48. Now let's try and divide this number by 8. So 8 ones are 8, 8 ones are 8, and 10 minus 8 means 2 carry over. So 8 twos are 16, so 4 carry over. 8 fives are 40, and then the remaining 3 zeros. So Q is equal to 125,000 units. So basically here, since we are saying that on an average the check for a customer is $8, this number indicates that to achieve a targeted operating income of $150,000, we need to have 125,000 customers with an average check of $8. So now basically we have to find out the revenue. So revenue is equal to number of units sold multiplied by the unit selling price. So this is equal to 125,000 multiplied by 8. So 3 zeros, 8 fives are 40, 8 twos are 16 plus 4 20, 8 ones are 8, 9 and 10. So this becomes $1 million per year should be the revenue in order to achieve a targeted net income of $105,000.